Well, good afternoon. This is Mr. Not Advice. It is Tuesday, August 18th, 2026. This is my end of the day wrap up. As always, it's for entertainment and education purposes only. Well, I could have slept through this whole day today, as shown here from this first graphic. Look at the volume relative to the 30-day average. The SPY down 60%, Q's down 16, Nvidia minus 50. These are fairly large moves or drops in volume. Yesterday did half the volume of Christmas Eve day, which was a half day of trading. And so volumes are exceedingly light right now. Part of the reason I think is because so much attention and capital is flowing into the AI complex via debt markets that there's only so much money, a finite amount of money in the world. And right now, the hot money is going into AI and the build out. So I think part of this is attributed to that. Additionally, you're probably hearing on the news the term bond vigilantes. I don't think it's really the bond vigilantes at work yet. Looking at, and I'll get to that, looking at the overall market today, it wasn't necessarily a bad day. You can see there's quite a bit of green on the screen. We had banks doing well. We had consumer durables doing well, energy stocks right here doing well, industrials doing well, healthcare doing well. But the sector that has been leading the market higher, AI as well as chips, when that falters, it affects everything. So, taking a look at the market today, it appears as though all of a sudden, and this might be due to an overnight note from the Wall Street Journal that's talking about a $3 trillion debt bubble that's off balance sheet, which, if you've been listening to me, I've been commenting on that and how I think that's going to end. I think it will end in some sort or some form of federal bailout. I don't think there's any way to avoid that. But we did have NVIDIA pull back today on an announced $250 billion financing that it was going to support in Ohio. They've reduced that commitment down to $105 billion. However, that is part of that new collateralized compute obligation or CCO, which is complete and utter bullshit. Whenever you hear that there's a new asset class or product being offered, it's because the current ones aren't selling enough or they need to have more capital raised than perhaps the current product is capable of. So they have to spin up a new descriptive story. Looking at rates and credit, the US 30-year is its highest level since 2007. The Japanese bond at 10-year since 1996. This is not a good look. And if this continues, it's going to put pressure on the equity market. Again, I think what we're seeing here is not only the spillover effect from rising deficits throughout Europe and Asia, as well as the US. I think the US is obviously in a much better fiscal picture due to a couple of things. Number one, we have a significant reduction, it appears, in illegal immigration and the monetary support they were receiving. We have Doge cuts that have trimmed the federal budget. And then on top of that, we also have tariff income, which right now is not getting a lot of news. But all of those things, I believe, add up to the US being in the strongest position from a global economy standpoint. However, I also believe that we're seeing spillover effect. I've been saying this for weeks now that you cannot have corporate debt at the level it's being raised in the corporate bond market for hyperscalers and the build out and the premium that they're commanding in additional to the widening credit default swaps. You cannot have that without some spillover effect into the long bond, the 30-year and the 20-year. So some of this is due to the sheer amount of capital that's being poured into the AI infrastructure build out. Remember, as I said, there's only a finite amount of money in the world. And so much capital is being poured into that it is reducing the amount of capital flows into the stock market, and it's going to start hurting both consumer spending and companies' profits if this continues on for a longer period of time. Oddly enough, even though we had the aggregate yield on all terms, according to Bloomberg, has also broken out from the 2023 high. And that's interesting because that's along with improving global macro data. Typically, that's not something that you see. Rich Pravoratsky concludes that the Fed might be even forced to hike into weaker inflation data in order to flatten out the curve and re anchor the back end. Simply put, hyperscaler capex needs are triggering a competition for capital that is crushing sovereign bonds. Ironically, treasury yields ended lower on the day, led, even more ironically, by the long end of the curve. Admittedly, only a 1 to 2 basis point close to close change reduction, but it's 4 to 5 basis points from the overnight highs. High yield tech spreads, as is shown by this chart, are absolutely blowing out right now. Again, I think we're seeing some of that bleed over into the sovereign bond market. Nvidia now is as risky as Meta, as all the AI hyper CDS credit default swaps are widening out. Of course, the poster child remains Oracle, with SpaceX and CoreWeave second, but well off the level of Oracle. Mega cap tech stocks today came under pressure amidst the on again, off again confidence in the sustainability of the AI trade, but there was really no headline catalyst today. We have one major company still to report, and that is NVIDIA next week. The broad AI basket, however, was clubbed like a baby seal today, and that helped to drag the NASDAQ lower, which was the biggest loser, down over 1.5%, and it did weaken into the close. All the majors were red today, but the Dow was, for a change, because of its composition of industrials, was the strongest today in a down market. One major standout today or data point was that the advanced decline line today was very strong. So strong breath, given the ugly headline. All the AI leaders were hit today, with optical networking being the worst performer today. That basket down 10%. Looking at oil, President Trump rejected extending the U.S. Iran ceasefire agreement, which technically expired on Monday. The U.S. Strategic Petroleum Reserve has fallen to 293 million barrels at its lowest level since 1982, after the Trump administration released another 5.3 million barrels last week to try to contain oil prices. On top of that, and with the ongoing massive attacks, 600 drone attacks hit Russia last in the overnight, which again, about a third of their refining capability has been taken offline. But despite that, oil pretty much closed unchanged today, despite the fact that Trump claimed that the Hormuz was open and operating and had been cleared of all mines. Both statements, I think, are complete bullshit, by the way, because any ship that's trying to make it through the Hormuz is now being accompanied by U.S. Navy ships. Crack spreads remain dramatically elevated, with diesel crack spread busting out to new highs, which is going to put a tremendous amount of pressure at the wrong time on Europe. Also, diesel used for transportation is could be the first domino to fall if and when the US and its allies are unable to keep the price of oil compressed through the use of the paper market right now. The dollar ended marginally higher on the day, so there's no panic right now in the US dollar, and it remains flat on the week in terms of fear, despite CNBC trumpeting out the bond vigilantes term. USA sovereign CDS remains unnerved at this point. And so the cost to insure against default by the US sovereign bonds is not rising. If there was truly a concern, even a macroeconomic concern about the US, you would certainly see this start rising also. Looking at the overall market today, a whole lot of nothing to do. We had four trades we tried to get into this morning, none of which we were able to execute on. Our only remaining position we have that we recently opened was ConocoPhillips. We got into ConocoPhillips. We have already scaled for plus 25 and plus 50%. Today we are up over plus 75%. Hopefully tomorrow we'll hit that plus 100%. EOSE had a weekday today of slightly below average, 28,789. But remember, with the Russell down 39, almost 40 points, small caps will get hit harder when interest rates or the fear of interest rates rising because they are much more dependent upon the credit markets relative to the size of their balance sheets as well as revenue structure. So it is possible that we see EOSE, and I think it will happen, that we will see EOSE print a two handle, whether that's 299, 279. I don't know yet. It depends how long this stress remains in the market. But there is, from a flow standpoint, as we can see by the first graphic I showed you, the table with the 50% of average 30-day volume in a lot of the stocks, there is right now a sort of a big old sucking sound coming out of the equity market as dollars are being pushed into fund the AI build out through the corporate debt markets. There's only a finite amount of capital. And as I think Goldman said, at some point that capital is going to start hurting on the consumption side also, as credit issuance to consumers, and that includes car loans and house loans, they will have to be pulled back too. Not saying to the point where it's going to bring our economy to a grinding halt, but certainly with the US stock market, right now the hot asset are these so-called investment grade bonds with hyperscalers, even though, as you know, I think that's a bubble that will eventually burst painfully for a lot of players in the market. Until we get some more visibility both on interest rates as well as the war in Iran, I think that this market's going to be very difficult to catch any sort of prolonged bid. In fact, we have now entered the strongest period for the VIX as from a calendar standpoint. The VIX is pretty much on an upward slope from now through December. Additionally, with the midterm elections, I believe it was only 2006 that saw a positive return from the month of August 1st through the election date in November, with the average midterm election period returning minus 7%. And that's according to Bloomberg. So it's going to remain a difficult market. One thing that might start coming into play is that Trump's approval rating dropped to 33%. And while he's talking about he's not really focused on the midterms, he's absolutely focused on the midterms. Therefore, at some point, and that might be when oil, it appears to be above $100 a barrel, is where Trump might get involved. And you may see it this week with a extension of the ceasefire for a much longer period of time, let's say 90 days. We tried to get into PCT today. Here's a perfect example of a trade we try to get into. We had this bullish engulfing yesterday. We were never able to clear this top side, 722. So that now is my buy level. Also happens to be right at the point of control. We tried to get into a energy company, NOG. Once again, we needed it to get above this level at the open. It was not able to do that. Thankfully, we didn't chase it and it came right back down. There really isn't a hell of a lot of trading going on right now. And that, for us, for momentum traders, makes it a little bit more tricky and difficult. But if I'm focusing on what catalyst could eventually, where the market really drives down much harder, is real rates. Real rates currently are stuck between 2.4 and 2.6%. And that means that risk assets are increasingly relying on an easing cycle that is visible in expectations, but it's still, until they do it, it's still not going to reflect in long term discount rates. Ultimately, the market is treating slower growth as a reason to own risk. But the bond market right now is not fully convinced. And again, I think the bond market is being temporarily affected by the sheer amount of debt issuance that's occurring in the investment grade chuckle AI debt market. All in all, a very boring market today. Nothing to do. I hope you had a good and relaxing day as the summer starts to come to an end. Hopefully, we get another shot at trading tomorrow morning into some trades. Oh, by the way, the recent rise in Bitcoin from the experts that I follow, they have no reason why Bitcoin should be rising. If we look at the 45-day standard deviation chart, now we've reversed right back to the mean. Can this continue? Absolutely. Do I think it's going to continue? Absolutely not. But I'm not a Bitcoin guy, so I could be absolutely wrong. So I'm keeping an eye on the 30 year while at the same time chuckling over the fact that it was just over 2 weeks ago when the market was selling off due to situational awareness failing, as well as just the sheer amounts of leverage. That got fixed in less than a week, if you remember, and the all clear sign was given. And here we are today, down 500 points on the NASDAQ. That's a little bit concerning because one of the things we were seeing at towards the end of last week, at least for the better part of the week, was a compression in the daily range of the market become very, very quiet. I think perhaps what we're seeing today is some preemptive selling or deleveraging that's going on in the market in case of another stronger move downwards. Tomorrow, we do get the Fed notes, so it'll be interesting to see if the market reacts to that. I don't expect anything major out of those notes, although there could be somewhat of a hawkish tilt, which might spook the markets again tomorrow. So, anyway, I hope you're doing well, and I will talk to you all on the board.
Yeah, we gon' make it out. It don't get no greater. Feel like I'm on fire. Feel like I'm Johnny Storm. Feel like I'm volatile, explosive. Get close enough, you notice. Your girl, I got a character.